Do you know what we do? We always working.
I know, but you're gonna have a little bit too many drinks on Thursday. I can imagine. 4th of July. It sucks. It's in the middle of the week. Perfect. We're gonna get started now. Have the people come in little by little. Either way, we're gonna catch up on some news. Last week I was out of town on vacation, so we did not have Monday Mortgage Minute. So we're just gonna kind of briefly go over the sales numbers nationally and PCE, and then we'll jump into Hometown Heroes and talk about the just got to get a refresher ins and outs so that when you're having conversations with clients, there's a lot of misconceptions about um, mortgages in general. And so just try to figure out a way around it for them and to give them the opportunity to be able to qualify for Hometown Heroes and just understanding and knowing what um, to tell them and what to talk about with them. So personal consumption expenditure, which is PCE, came out last week and showed that inflation decreased, which is nice, from 2.7% to 2.6% for the headline number and core inflation, which strips out food and energy. This is big since this is what the Fed is looking at to get to their 2% number to start cutting rates. Remember that they look at PCE, the big headline number is, or the big headline index is always CPI, which is Consumer Price Index. What the Fed looks at is PCE, and that getting closer to that 2% is actually really nice. Hopefully June ends up being the same, and then maybe we'll start seeing some rate cuts sooner than later. The National Association of Home Builders came out with their June housing market index, showing their sentiment at 43. So this is a scale that ranges from 0 to 100. Anything above 50 means that they're considering building. Anything below 50 means contraction. So they are slowing down on building. It shows in the housing permit numbers as well, which is down 9.5% year over year. And permits are usually the first step to starting the build. They did have 1.51 million completions in May. However, those completions have pretty much already been under contract for quite some time. You know how it is with new construction, right? For those of you that sell it, they get under contract usually before the home is built, and they're there waiting for about a year for it to finish up. There's some good that does come from this. It's keeping prices elevated. They're not overbuilding, and we see why with the new home sales numbers, which are new construction homes. Those show signed contracts decreased 11.3% from April to May, and they're down 16.5% year over year. While that number seems large as a percentage, the number of signed contracts was still 619,000. So still very elevated in terms of number of new construction homes that are going under contract when you look at the number, but it is much lower than this time last year. And it's because of the slowing down in building as well as the buyer sentiment too. Existing home sales, which are sales on existing properties, also fell 0.7% in May, and they're down 2.8% year over year. While pending home sales, which are pending listings that aren't closed yet, but they're under contract, fell 2.1% from April to May, and they're down 6.6% year over year. We're starting to see a slow turn, as you can see with these numbers, into a buyer's market with inventory slowly increasing, but sales slowing. That, however, isn't killing appreciation because Case-Shiller came out with their home price index for April, and it showed a 0.3% increase month over month and a 6.3% increase year over year. So appreciation still holding strong. Even though inventory is increasing for existing homes, they're decreasing for new construction, as we can see from the numbers we just did. There's owners that are coming out and still trying to list their properties, and actually the owners are getting a little bit anxious because they've been trying to hold off for so long. I am going to put this up on my other screen while I share this one. Yeah. There it is. And I just wanna first get open the actual. Let's see, and they released the rates for today, so we'll talk about that too. Beautiful thing is that we have Monday Mortgage Minute at 10 a.m. and Hometown Heroes opened up at 10 a.m. So the team is locking some people that we have under contract right now, and we can talk about what the rates look like for today, and then also what the updates are for Hometown Heroes. For those of you that didn't take the little webinar that they typically have, usually it is for lenders, but I've seen sometimes where realtors are able to get into them. There hasn't been many updates, but we're just going to kind of give ourselves a refresher so that when you're speaking to clients, you're able to educate them and let them know that it is possible for them most of the time to be able to take advantage of this. So first off, Hometown Heroes is 5% up to $35,000. It's not $35,000 automatically. It's always going to be a percentage. The only time you're going to hit $35,000 is if you're at $700,000 plus purchase price, right? Because that's where 5% of $700,000 is $35,000. The minimum that person will get is $10,000. So if they're below $200,000 on their purchase price or on their loan amount, they will still receive $10,000. Okay, that's the way that it works. Most of the time, that number is the 5%, right? It is for FHA, VA, USDA, and conventional loans. It is not for non-conforming loans. Bank statement program people, the self-employed clients that don't really file their tax returns, they're trying to find another route. They cannot do Hometown Heroes. These are just for standard conforming loans, which are FHA, VA, USDA, conventional, okay? The minimum FICO is still 640, and all borrowers on the application must meet that. Even if they're a co-signer, they need to have that 640 FICO. The income limits are based off of what we put on the application, not household income. Super important. If you guys don't know the difference, application income is the income that we use for qualifying purposes, okay? Meaning, if the person makes $100,000 base salary and they make $20,000, or sorry, let's say another $50,000 in bonuses, they make $150,000, and then their wife makes $50,000, they're at $200,000 together, right? Well, if we don't need that $50,000 of bonus income for qualifying, we don't need to use it. So we could use the $100,000 base, the $50,000 base for the wife, and still qualify them on Hometown Heroes. Okay, it's whatever I put on the application. As long as it's the base income that I put, it's fine. I don't need to use overtime bonus or commission if it will put them over the income limit. When it comes to household income, that's different. They're going to use whatever your income is all in, including if your wife is not on the application, and use all of that income to see if you qualify when it comes to household income. Anybody that's living in the property and what their year-to-date is. Application income is whatever I deem that could help them with qualifying. So I'm able to maneuver that. So just because somebody says I make $200,000 a year, you want to ask them, what's your base? And if everything else is incentive-based, like bonus or overtime or anything like that, we don't need to use it. Okay, we can work around that. We can use overtime and not bonus. It's whatever we deem that we can qualify them for whatever they want. Okay. The income limits, it's the highest of all programs. Miami-Dade is now at $170,250. Broward is $158,400, and Palm Beach is $160,650. Of course, there's other counties, which you guys should have the list, because I sent it over to everybody, that shows all the income limits for every single county. This is based off of the loan amount, not purchase price. I usually say purchase price because a lot of times the client is coming in with minimum down payment, right? So for instance, sorry, if I ask you to unmute, that's by accident. I'm just trying to mute everybody. For instance, if we're doing a $500,000 loan, or sorry, $500,000 purchase price, the loan is probably going to be like $480,000, right? Something like that. We're going to do the 5% based off of the $480,000. I usually say I just say purchase price just because it's easier, but just understand that it's based off of the loan amount. But if you're doing minimum down payment, they're both going to be right next to each other. Okay. Co-signers are allowed, and this is not to be confused with a co-borrower or non-occupying co-borrower. Okay, co-signer and non-occupying co-borrower are two different things. A co-signer is not on title. A non-occupying co-borrower is. Judy, I didn't even know you guys could do that. But that's okay. Income is used towards the income limit. So this is one big difference between Hometown Heroes and bond. And this is where it could get a little bit confusing for you guys. If you have a cosigner on Hometown Heroes, because it's on the application, we have to use that income towards the income limits. Okay, because that cosigner's on the application. If we were to be doing Florida bond, where they look at household income, the cosigner's income doesn't count towards that household income. And that's where sometimes we can maneuver the programs depending. If the borrower makes $75,000 a year and the cosigner makes $200,000, they won't qualify for Hometown Heroes, but that person will qualify for Florida bond. Okay, it's a little bit confusing, but just know that when you're looking at Hometown Heroes, anybody that's on the application, their income will be used towards the income limits. You must be full-time and purchasing a primary residence. So last year, the parameter was the employer had to basically state that the client works 35 plus more hours a week. In this case, the employer does not need to say that anymore. They just need to say that their employee is full-time, whatever that employer deems full-time to them. It could be 30 hours, it could be 25 hours a week. If that employer deems that as full-time, they would qualify. So a slight change. That's probably not really going to be that relevant. Full-time, they're fine though. Okay. Non-purchasing spouse does not have to be first-time home buyer, meaning if the husband or wife qualifies on their own and the other spouse had purchased a home before or isn't a first-time home buyer, you don't have to worry about that person if they're not on the application. You only have to worry about first-time home buyer eligibility with people who are on the application. Okay. If they're both on the application and the co-bar is not a first-time home buyer, they won't qualify just because the primary is. Okay, unless they're not occupying the property. That's the only difference. You're not occupying the property and you're on the application, only that borrower needs to be the first-time home buyer. No cashback is allowed to the borrower, and this includes their deposit. Okay. Only gift funds can be returned. This is super important with this program because a lot of times what happens is on an FHA loan, 3.5% down, the cash to close is like $6,000 realistically, right? Before you even put down any money, that's usually where your cash to close, $6,000, $7,000. Now, let's say you put in your earnest money deposit, $5,000, your cash to close is $2,000. But now you get a $10,000 seller credit. You think that you're going to be able to get your $5,000 back of your deposit because you're going to use the seller credit towards the closing costs and Hometown Heroes for the rest. You technically cannot. Okay, you cannot get your EMD back. The way that we've gotten around this for the last few years is right before closing, we get this listing agent to agree to lower the EMD amount to a lower number. It could be $1,000, it could be $500, whatever. They lower it down. They get an addendum lowering the initial deposit down, and that's the only deposit that's counted towards the transaction. So anything else will be given back to the borrower after closing, okay, or right after they sign. So that's the loophole around it. But if there is no addendum, if the listing agent says, I don't trust you guys, absolutely not, I'm not doing that, they have to include that EMD at closing, okay? Application /1003 to verify first-time homebuyer eligibility. No taxes needed. So this is really important, especially when it comes to FHA loans. With the Florida bond, we need 3 years tax returns, okay? And with those 3-year tax returns, what they do is they see if you've ever gotten a tax credit for mortgage insurance or interest that you pay on your mortgage through your primary within the last 3 years. That's how they determine your first-time homebuyer eligibility. With Hometown Heroes, you don't need those taxes. That's important because a lot of people in South Florida, they'll have their main W-2 job and then they'll have something that they really don't do anything on, but they just use that on their Schedule C to write off a lot. If we show the tax returns on an FHA loan, we have to include that negative income, no matter what, or positive income, no matter what. Okay, and this can kill somebody's loan, okay? Extremely important. So if we don't need tax returns, we don't need to worry about it, okay? It's the one downfall when it comes to Florida bond. I'm trying to do an FHA loan. When you see those tax returns, if they show negative income, you know that there have to be They either have to amend their taxes to show no negative income and just zero it out or completely remove it. And that takes a little bit longer to draw out the process. In this case, for Hometown Heroes, that is not the case, okay? We don't need tax returns. It is not forgiven. There is a balloon in 30 years. That's another question that I get. You know, what if I never refinance or sell the property? Will I have to pay back the loan? Yes, you do, technically. In 30 years, there's a balloon payment that makes it due. However, we're not in an environment where you're never going to refinance. This is not 2020, 2021, where you're going to write out at 3% or anything like that, right? You're going to eventually refinance when rates come down. If they come down to the low sixes, high fives, or something like that, you will refinance, and at that point, it'll be paid. But if you were to technically never do it, you would have a balloon in 30 years, okay? Veterans do not have to be first-time home buyers, okay? And they don't need a certificate of eligibility. They do not have to be a first-time home buyer. They can qualify for this loan, even if they already had a primary residence in the past. Shaniqua, you got a question?
Yes, the balloon payment in 30 years, will they allow them to finance it or they have to pay within like how long?
Technically, you can finance it, right? In 30 years, let's say you're about to finish your loan, you could just do a cash out refinance at that time and just pay that off.
Oh, okay, great. That's good. Okay. I
Yeah.
just wanted to know an option for people so it wouldn't scare them.
Yeah. You can technically refinance at any point right before it's due. And then that way you pay off your first mortgage and then you just refinance and just pay that one off.
Okay. Okay, cool. All right.
Kalia said for veterans, they will have to purchase their primary home, correct? Yes, it has to be a primary residence. Either way, you can't use the VA loan without doing a primary. But let's say they're a veteran and they're trying to do conventional, which they can, that's fine. It has to be a primary residence purchase for Hometown Heroes. This is for any 1 to 4 unit properties, okay? So it could be a condo, single family, but here's where I don't want you to get mixed up. Remember that there is no purchase price limit, right? Where a lot of down payment assistance programs, they'll say your max purchase price is X amount. They have max loan amount limits, okay? So, and their loan amount limits are based off of the conforming loan limits within the area. It's only based off of one unit. So I'll break this down for you. For instance, right now for FHA in Broward and Miami-Dade, the maximum loan amount for a 1 unit property is $621. For 2 units, like $750 something. For 3 unit, it increases, and for 4 units in the $1 million range, right? Same thing for conventional. It's at $721 on 1 unit. It increases per unit that you go up. Hometown Heroes does not do that. They're based off of an income limit for a 1 unit property. Okay, based off of the conforming loan limits in the area. So you can't go and get Hometown Heroes and try to find a 4 unit at $1 million because they won't get the Hometown Heroes because the maximum loan limit that they can do is $621. They'd have to close that gap. Okay, their loan limits don't increase per unit. So just keep that in mind. Veterans, if they have a property, can they rent out their current property? Yes, departing residence, basically. Yes. So a veteran can do a departing residence on their current property and move into a new one, okay? The issue when it comes to VA is it's not like conventional where they wash out the payment, okay? It's actually more closer to FHA where they'll hit you for that liability. There's loopholes around it. The loophole is basically if you've ever had any sort of experience property managing or as a landlord or anything like that, which FHA does not allow. So if that veteran, let's say, was the leader of their barracks at the time and they were in charge of everybody and their housing and stuff like that, that could technically qualify as landlord experience. So there's ways to get around it. Just getting literally a nice letter of explanation from that person basically stating what they did or anything like that, or if they work at a property management company on the side or something like that, they could use that as a reference too. But if they have no landlord or property management experience, they will have to get hit for that income. For that mortgage. Shaniqua, you got a question?
Yes. In 30 years, will there be interest added to this payment or is just a flat 35,000?
Flat. Whatever you borrow is the amount of money that you will take back. It is 0% interest.
So how are they making their money? Is it the set interest rate that you're given when you get the loan?
Great question. It is the servicing of it. The servicing is going to be, when it comes to mortgage lending, it's a little bit confusing on the back end. I can tell you that the way that they make their money is going to be, right, they're going to get their money back no matter what of the initial investment, but they're going to make interest off of the initial loan that they do as well, because they're the same ones that are servicing it in terms of the bank. The state of Florida is just offering this as an incentive. The servicer that services this, they're going to be servicing these loans for a lot longer than a regular FHA at a 6.75%, right? Because a person's going to think twice before refinancing and having to pay off that money, right? So they'll be servicing these loans a little bit longer. They'll be making a little bit more premium off of that higher rate. You had another question? No, okay. Couple other pointers. I got you, Sabrina. So what is being a first-time home buyer? Being a first-time home buyer does not mean never owning a home, okay? It just means not owning a primary residence within the last 3 years. Technically speaking, okay, and this is a huge gray area. They will vet this, they will try to look at it, and they will look at it much more strict than they would anything else, right? If you own an investment property and you've been renting it out and you currently rent out your where you stay, and you have an investment property that you have rented out to someone else, and you're going to have to show proof on your tax returns, right, for the last 3 years and stuff like that, showing it on your Schedule E that it's an investment property, not just a lease. You can still technically qualify as a first-time home buyer. It's as long as you have not owned a primary residence in the last 3 years. So if you bought that home 5 years ago, you moved out 2 years ago, and you've been renting it out for the last 3 years, you could qualify as a first-time home buyer, and you could use this Hometown Heroes program. Okay, it's if you have not owned a primary residence in the last 3 years. Another thing for you guys, realtor commission. Okay, the realtor commission, it can be paid by the borrower, but it's not using the Hometown Heroes funds. Meaning, if the borrower gets $20,000 and their cash to close is 6, and they're paying your commission, which is 15, their total cash to close will now be $21,000. Okay, that's how that works. Now, obviously, if they get those seller credits, it'll be reduced, things like that. But they cannot use the Hometown Heroes funds to pay off your commission, even if there's an overage. Okay. The employer must have a brick and mortar in the state of Florida. So this one is another change that they had. This one's going to be something that will catch people off guard as people start getting pre-approved. Just because you work in the state of Florida and you're a virtual worker and your job is in New York, and let's say they have a payroll in Tallahassee, right? They just have a place with payroll. You still will not qualify for Hometown Heroes, even though they have a payroll place down here. You have to have a brick and mortar that you can directly be able to go to and work out of if needed. So no virtual work, basically. Now, if you're a virtual worker, just because you're a virtual worker, and there is an office that you can go to, right? Like for me, for instance, as a loan officer, I could technically work from home if I wanted to. I would be able to qualify for Hometown Heroes because I have an office that I can go to. But if you're completely virtual, you're even if your offices or your company has something in Florida, but they're all online, you will not qualify. No more Fannie Mae on Hometown Heroes, only Freddie Mac. So what does this mean? Basically, before you had 2 options, right? You can either go through Fannie Mae or Freddie Mac. And the difference is that even though Fannie Mae and Freddie Mac are very similar, they have different appetites, okay? Fannie Mae may like a loan or credit criteria for a client or a borrower that Freddie Mac doesn't. So you'll get an approval on Fannie Mae and a denial on Freddie Mac. or vice versa. You'll get a denial on Fannie Mae and approval on Freddie Mac. There is no longer that two GSC advantage that we had before. It has to run Freddie Mac, which is not so important to you guys, but it does give us less leverage. I will tell you that from my experience, when we run Freddie Mac has been, especially very recently in recent years, much friendlier with clients that are lower credit than Fannie Mae is. So Freddie Mac will run at 660, 680 with minimum down payment, where we don't see that with Fannie Mae BU. And that's how sometimes a loan officer that's only running one may say that this client is not pre-approved. We get it. We can run the other one and get the approval. In this case, it's only Freddie Mac moving forward, which shouldn't be a big deal. This, like I said, Freddie Mac has been more favorable, especially with these down payment assistance programs. Shaniqua, you had a question?
I'm sorry. Yeah, I'm thinking of a lot of stuff. So,
Good. That's good. That's what we're here for.
okay, so could this work with an FHA 203K loan? Like if we find a multifamily that needs some repair, is there any way that the borrower can get repair funds to assist, in order to get something economical that's not turnkey? Because, turnkey multifamilies are costly.
Yes. The answer in short is yes. They do allow for 203K. It's a little bit more of a stringent process, but you can do FHA 203K with Hometown Heroes.
Okay. Okay. Is there any other type of repair funds sourcing that we can do? Like maybe what if they're conventional? 3%.
Conventional does have its own, but I don't believe Hometown Heroes allows it. I know it's pretty much only been FHA 203K, but conventional does have its home style product, which is actually really nice. But no, I think it's only FHA 203K for Hometown Heroes.
Okay. Okay.
Stephanie asked about the 3 years no residential home, to explain again. So basically, with the first time home buyer, right? What essentially is a first time home buyer is the question. A first time home buyer based according to the IRS, which is what a lot of what these programs go by, is a person who has not owned a primary residence in the past 3 years. Okay. As long as that person has not owned a primary residence in the past 3 years, they will be considered a first-time home buyer. That will include an investment property, maybe in another country that they own. They will still be considered first-time home buyer here. Investment property in another state or in another city, where they could show proof that they have been renting it out for the last 3 years. And by proof, guys, tax returns, okay, which is usually a little bit difficult to get from clients, but tax returns on the Schedule E will show that they've been renting it out for the last 3 years, and that will be more than enough proof to be able to qualify them for that Hometown Heroes program. A lot of clients think, besides the investment property aspect of it, this is just like a tip that I'm giving you all, so that way you know. Clients think that just because they owned a home 20 years ago, that they're no longer a first-time home buyer. No, as long as you haven't owned one in 3 years or primary in 3 years, you will qualify. But for you guys, take it a step further. If they own a home, but it's an investment, or they inherited it from someone or something like that, and they don't live in it, they will still be able to qualify as a first-time home buyer. Shaniqua, you got another question?
Sorry, I didn't lower my hand.
Oh, all good. Anybody else got any questions too?
Good morning, Mike. I have a question, and I'm pretty sure I know the answer, but this is not a good, or an investor couldn't use Hometown Heroes, correct?
No, not for an investment property, only as a primary residence. So you could use it if you find a multifamily, you're going to live in one unit and rent out the other. You can use Hometown Heroes. But
Okay, thank you.
no problem. I tell people very, very specifically, primary residence. A lot of times people will do the multifamily route, and they will, try to do Hometown Heroes and say that they're going to live in it and not. Hometown Heroes is not the program you want to do that with, because they will check the homestead exemption on, okay? And if you don't homestead, might owe that money within a year or two, which you may not be able to.
Okay.
Yeah, pay it back at that time. Can you explain again a balloon in 30 years? Yeah, Beatrice. So balloon payment is basically when in mortgage is essentially when if you have a balloon payment in X amount of years, that means that you're gonna owe that mortgage pretty much whatever that term is, you're gonna owe that mortgage at that time. So in this case, with Hometown Heroes, it is never forgiven. Okay, you have to pay it back at some point. You're usually gonna pay it back whenever you refinance or sell the property. Those are the two times that you pretty much will pay it back, okay? Or if you never homestead. Now, if you were to never refinance or sell the property and keep the property for 30 years and just make the payments until you don't owe the mortgage anymore, in 30 years, you will owe the second mortgage that you took out or the Hometown Heroes mortgage at that time because you're not making monthly payments on it. It's not accruing any interest. But if you borrowed $20,000 and you spent 30 years paying your mortgage, never refinanced or sold it, then at that point, you will owe that $20,000 in 30 years. But I tell people all the time, especially with these higher rates, you're going to end up refinancing at some point. So the rates, and I want you to look at this one here. Don't confuse it. No problem with this one. Okay. TBA and bond are different. Bond is going to consider household income. It's a little bit more stricter. So we go with the safer bet, right? Always when we're looking at pricing. So FHA, USDA, VA opened up today at 6.75. Freddie Mac, see, it doesn't say any Fannie Mae anymore. Freddie Mac is less than or equal to 80% AMI. These are low income borrowers. Their rate would be at a 7. Anybody that's over 80% AMI, which is the bulk of people, will be at 7 and an 8. I mean, these are great, especially considering the current market right now. These are great rates, especially to get the 5% down payment assistance. You'll notice that on the other programs that they have, let's say it's just the standard TBA one that they have, which we use quite often. To get $10,000, you'd have to take a 7.375% if you're over 80% AMI. So you would get less money and take a quarter point higher. And if you wanted to use their Plus TBA program, which goes based off a percentage, not based off of a number, to get that same 5% down payment assistance that Hometown Heroes is giving you, you got to take it at 8.5%, and you're less than 80% AMI, right? So these are great rates. Helps with people with qualifying. You know, especially since a lot of people are very high on their DTIs. Stephanie said, curious, in 30 years, owner dies, the beneficiary inherits the property. Do they have to pay the bill payment? Yes. It'll just transfer over to, once you do the probate, it'll transfer over. Which you want to make sure that you contact the servicer at that point, tell them that, you know, what happened and that you're going through that probate process, because if they don't get that, if that scenario were to happen in 30 years, owner dies, right when that balloon payment is due, and the beneficiary takes it, and they don't pay the balloon payment within a specific period of time, they don't tell the servicer anything, that technically they can foreclose on that home within that time frame, because they are a lien on the property. So if that were to happen, the beneficiary would have to reach out to the servicer, let them know that the you know, the owner passed away, go through probate, which the attorney does all that stuff. Which you mentioned homestead. What is this concerning? So usually when you buy a primary residence, Beatrice, you can go to the you get a tax break by it being your primary residence. You go to the property appraiser site, either Miami-Dade or Broward County, and you sign up for your homestead exemption. That basically tells the county that that's your primary residence, and so they give you a discount up to $50,000 of the assessed value. So if you purchase at $400,000, they're only going to tax you $350 if you're married, and they'll tax you $375 if you're single. Basically, you get a discount from $25,000 to $50,000. Stephanie's question actually brought us into perfect transition about probate. So next week, I will have a probate attorney talking the ins and outs about probate with you all, what to look out for when you're listing, when you're buying, and you can ask a ton of questions. She's very well versed. So it should be an exciting Monday Mortgage Minute next Monday. Any other questions before we head out for the day?
I have one more, Mike, please.
Yeah,
Okay, so is it possible for someone, let's say that they were able to pay off that loan in advance, is it possible for them to do so? And is there any penalty for doing so? Excuse me.
no penalty. There's no prepayment penalties at all. Is there an advantage? Not really, because it is 0% interest. It's not going to accrue any interest. So let's say they're not going to refinance, and in 5 years they just want to, that loan is bothering them. It's in the back of their mind. They just can't shake it. They have the money, and they're going to pay it off. They pay it off. Great. You don't owe that money anymore, but you didn't really do yourself any sort of service, except for now when you sell the property, you're gonna make that money back technically, but you're basically putting it there, almost like it's almost like a non-accruing interest piggy bank, right? Instead of putting it into a investment portfolio, E-Trade, where it's gonna accrue 5% every single year, you just knock down that second lien that you have that's at a 0% interest anyway, so that doesn't accrue. You're not doing yourself any favors, but it's also not a disservice, if that makes sense.
Okay, so it's better to just hold it for the life of the loan? Is that what you're saying?
Hold it until you refinance or sell. Now, if you're not going to refinance or sell, then yeah, you want to pay it off whenever you can. But I'm telling you, 6.5%. Let's say you're taking a 7%. If rates go down to 6% in 2 years, that person is refinancing. Don't let the client confuse you and say that they're not. They're going to. It happens. The only time you don't see people refinancing is going to be people with 3%, where you never see that rate again. And even then, believe it or not, refinances are up, and people are taking a higher rate because their credit cards, their APRs on their cars are also high. So they'll do a cash out refinance and go from a 3 to a 7 and get rid of the 24% APR credit cards that they have, the 12% APR car payment that they have, and just take a higher mortgage payment because it just makes sense for them. So I think the very few times that you see that people really didn't refinance and paid off their homes completely were our grandparents, right? And that's because they got their home at $60,000, $80,000. So their payment wasn't anything, right? There's a different time, higher loan amount, higher mortgage payment. You're going to take any $50 to $100 discount you can get.
Okay, thank you.
No problem.
I do have a quick question, Mike.
Yeah.
What about how does this work with the condo? Like, does it eat into the high down payment?
Great question. I didn't cover this. So if a condo doesn't have a budget, let's say they're not Fannie Mae approved, we got to do it as a limited review, right? Completely. Well, in that case, they can utilize Hometown Heroes, but they still have to come in with that 25% down as their first loan, right? Remember, so those of you guys that don't know, when you're doing a condo, there's 2 types of reviews, a full review and a limited review, right? On a full review, you could do low down payment without a problem. That's because the budget is intact, everything's good. On a limited review, there's no budget, no reserves, or anything like that, or anything like that. So you have to do 25% down is now where it goes to, right? That's the minimum down payment. Well, Fannie Mae and Freddie Mac basically say that you could do 25% down, but get a second mortgage up to 90% LTV. So that client would still technically have to come in with 10%. I say all that to say this. You would do 25% down on the first loan. Hometown Heroes would help you with 5% on the second. So you would be coming in with 20 as opposed to 25. It depends on the client. If they have the money and they just want to leverage Hometown Heroes, then they would take that option, especially if they really like that condo and don't want to give it up, and they're willing to do the 20% down. If they don't have the money, then the other option would just be not doing Hometown Heroes and doing a HELOC, and then using that HELOC to get you down to where you only need 10%. So there's different options. But to answer your question, you can leverage Hometown Heroes. There's a client now that I have that is pre-approved, that has the money, that is looking at condos. A lot of them have to be limited review. And so she's either considering doing, the Hometown Heroes and coming in with 20% because she doesn't want to pay the interest-only payments on the HELOC, but that she also is considering maybe doing the HELOC and coming in with less down payment. So yes,
She's taking a HELOC on a house on a condo that she's purchasing?
Yes. So Do you know the strategy of doing a condo that doesn't have a budget at 10%?
Yeah, is that the piggyback?
That's the piggyback. The piggyback is a HELOC. A lot of lenders,
Oh,
don't, but it's a HELOC. So it's interest only. Yeah.
okay, so it doesn't eat into their out-of-pocket costs, but it'll be added to the loan balance, the Hometown Heroes.
Correct. Yeah. So
Okay.
instead of them coming in with 25%, they come in with 20, basically. That's it.
But the money does go towards the loan balance.
Yeah. Towards
Okay.
the loan, towards the down payment, technically. Yeah.
Okay.
Stephanie said, explain the piggyback. So basically, when a condo doesn't have the reserves and it's a limited review, Fannie Mae, Freddie Mac say it automatically has to be 25% down. Is the loan to value has to be 25% down. But the combined loan to value can go up to 89.99%, basically 90% LTV, which means that what they're saying is your first loan has to be 75% loan to value, and then your second loan could be up to 90% loan to value. So what clients do is they basically will take out their normal first loan conventional at 75%, and then they'll do a piggyback, which is a HELOC usually, up to 90%. And then they only come in with 10% down plus closing costs and stuff like that. And that's how they'll leverage not having to come in with that big 25% down on a condo that doesn't have reserves.
And that's only if the association allows that, right?
Correct. Yeah. Only if the association does not have a minimum down payment requirement. That's it. Any other questions?
And I asked you to briefly explain a HELOC.
Yeah, a HELOC is a line of credit on the property, right? So it's basically when you're doing it on a condo, you're coming in with a full draw essentially. But a HELOC is almost like if you were to do a credit card, but take it out on the equity of your property. Let's say your property is worth $500,000, you owe $300,000, and you want to take out $100,000, right? That would be your HELOC of $100,000, and so you could use that line of credit towards paying or buying a new property as an investment, maybe putting a higher down payment on your new primary, paying down your bills, or anything like that. The benefit of a HELOC right now is that a lot of people have a low rate first loan, right? And they don't want to touch their 3%. So instead of just doing a cash out refinance where they would just do everything together, they're keeping their first rate of the 3%, and then they're taking a HELOC, which usually is about 11% interest only payments, but for a lesser amount. And so that's what that HELOC will do. It just gives you money that you can access to be able to do renovations, pay off, debt, or whatever the case is.
Okay, thank you.
No problem. Hey, Shan.
Hey, I have a question. What's the max DTI for Hometown Heroes?
Great question. 50%. 50%. And I have to ask them because we would leverage up to 50.4 before because they would round down. So we used to get so close with our DTIs on some clients to make the deals work that we would have to go to 50.4% and not go to 50.5. As soon as you go to 50.5, it'll round up. But I think that they put something there in their guidelines that I saw that basically stated that they're going to round up on if we're at 50. So that may not be the case anymore, but the baseline is usually 50%.
Perfect. Thank you.
No problem. All right, y'all. Thank you so much. We will be back next week for sure. I'm going to lock in the probate attorney. I'll send the information. That way we're ready. Make sure that you guys have a lot of probate questions lined up that you're curious about, because it should be a good one.
All right, thanks.
No problem. Have a good week.
Thanks, Mike. Appreciate it.
No problem.
Thank you so much. Have a great rest of your day.
You too.